If you measure the Philippine economy purely by standard news headlines, the outlook appears restricted. In the first quarter of 2026, GDP growth reached a post-pandemic low of 2.8%. At the same time, inflation hit a three-year high of 7.2%. But data from the Philippine Economic Zone Authority reveals a sharp deviation from that trend. In April alone, approved institutional capital commitments reached 63.9 billion pesos, a 1,296% increase over the previous year. We are seeing a distinct behavioral divergence. While retail investors react to inflation by fleeing the market, institutional capital is moving in. Why are global multinationals committing billions to the Philippines, while domestic sentiment remains at record lows? And how can you position yourself to capture the upside of this discrepancy? While news cycles prioritize immediate political and price shocks, these capital commitments align with a different set of metrics. To see what the institutions are measuring, we must audit the actual flow of funds. Let's isolate that capital surge. From January to April 2026, PEZA registered 109.4 billion pesos in total approved investments. Despite global headwinds, that represents a 72% increase compared to the same period in 2025. When we break down the April numbers, we find that the capital is highly concentrated. Out of the 64 billion pesos that entered the country that month, roughly 94% came from just 5 big-ticket projects. This cleanroom facility illustrates the type of infrastructure these funds are building. This capital is being deployed into advanced semiconductor manufacturing and new aviation aerotropolises in locations like Clark and Cebu. This is heavy industrial infrastructure. Unlike speculative trades that can be exited instantly, this capital is being used for physical construction. It anchors itself to the country's industrial base, regardless of short-term fluctuations in national GDP. This raises the core question: what is the specific mechanism overriding the fear? Why are these foreign corporations moving forward despite the Middle East oil shock and a sluggish 2.8% growth rate? The catalyst is the Create More Act. Its provisions provide the framework for the recent capital influx. After an initial income tax holiday of 4 to 7 years, enterprises transition to a permanent 5% special corporate income tax. When corporations calculate risk over a 20-year horizon, a predictable tax structure provides a significant buffer. That operational discount provides a yield that outweighs the friction of local short-term volatility. Institutional lenders are following the same logic. The World Bank is currently preparing to approve up to $2.4 billion in financing for Philippine infrastructure and development programs. When you combine that scale of global financing with the Create More tax incentives, foreign direct investment appears to be operating independently of the domestic narrative. Now that we have audited the data, we need to translate this mismatch into a tactical strategy for your portfolio. We call this the Alpha Protocol. It requires you to filter out daily headlines and strictly follow the physical flow of institutional capital. The first actionable sector is industrial real estate. New laws now allow foreign firms to secure 99-year leases on private land, and the tech manufacturers entering these economic zones will require extensive long-term physical footprints. The second sector is banking. While foreign capital covers the direct investment, local financial institutions provide the leverage and domestic financing for the side projects linked to these PEZA and World Bank initiatives. The third sector is construction and logistics. Building out these aviation hubs and ecozones requires moving immense volumes of material. The firms handling that supply chain are positioned to absorb this infrastructure spending. In the market, noise is the enemy and data is the weapon. Most of the public is reacting to fear. Institutional capital is reacting to the math. The choice is which group you intend to follow.